Okay, so great. We're going to kick off the seventh annual Applied Value Investing Pitch Contest. What I think is important for me to share is that this is something that I firmly believe represents the best of the tradition of value investing at Columbia Business School. The submissions were all outstanding, and it was very difficult to choose just 4 finalists. That is a real testament to the hard work of all of you guys and the great classes that we're going to have to fix this. People cannot stand up here. The great classes that you guys are taking and putting into real life investment potential. My hope is that this is something that's useful to you as you go forward out of Columbia Business School, and that you will build here and through events like this the kind of relationships that we on the judging panel have built. It is a very collegial business, and we hope that it is demonstrated in our actions, and we hope that you are able to take it forward. So without further ado, Paul, if you will give a little bit of a background, and then we will get started with our pitches. Thank you.
Thank you, Jenny.
Unlike Jenny, if there's an open mic, I'm not far. All right, I think I have some slides. It was a joke. Well, part-time professor. All right, there you go. All right, this is the 7th annual, or the 2nd annual, or the 8th annual, or the 16th annual, depending on how you want to count. All right, we've had 16 events that have all linked here. Here's the past winners, and somebody tonight will be added to that list. As Jenny really talked about, this is about relationships and legacy, and I want to talk a little bit about that. And there are a couple of people here tonight that I'm going to single out, primarily the judges. And the key, well, I'd rather speak without it, though. Okay. The key is that everybody on the judging panel and the organizers are doing this for free, and they're doing it to give back, and they're doing it because they love fundamental investing. They're very committed to Columbia Business School, and they want to be able to help nurture along the next generation of fundamental investors. So I want to talk about that. The fun part about being at Columbia Business School is it's the beginning of value investing. It started in 1927. Young Ben Graham came to teach at Columbia Business School. At the time, it wasn't a business school yet. And he had a 29-year tenure from 1927 to 1956. Wrote 2 books, Security Analysis, which is sort of the Bible of the business, and then The Intelligent Investor, which Warren Buffett says is the best investment book he ever read. In fact, reading that convinced him not to go to Harvard Business School, where he didn't get in, and to go to Columbia, where he did. And on the admissions process, he actually got to meet David Dodd, and his quote apparently is, "I thought you guys were dead." David said, "No, we're pretty good." He's had some pretty famous students, obviously Buffett being the most important. Roger Murray took over when Graham retired in 56. He taught for 21 years off and on from 1956 to 1977. And let me go back to apologize one more thing. The important thing is what Ben pointed out is the difference between price and value. And he was the first one to articulate in a very structured way that price and value could deviate. Because if price and value never deviate, there's no advantage to fundamental investing. When Roger came along, he was an institutional investor before he became a professor. And what he brought is this idea of discipline and rigor. Because the markets were getting more competitive, you might say they were getting more efficient. So his big contribution was this idea of discipline and rigor. And I think that worked very well for somebody like Mario Gabelli, who is incredibly creative, Leon Cooperman, incredibly hardworking. He brought that discipline and that rigor to the business. In 1993, Mario convinced Roger to come back and give 4 90-minute lectures without notes, by the way. He was 86 years old, at the Museum of Radio and Television. And it was pretty impressive for him to talk about the legacy. He had known Ben. He had helped work on the 1961 edition of Security Analysis. So pretty cool there. And then the next person in our story is Bruce. And I had the opportunity to really work on Bruce for a very long time. I was definitely a mentor early in my career, both as an investor and as a professor. He wrote a very important book, which was co-authored by Paul Sonkin, who's here tonight. And what Bruce really did for the first time is he connected competitive advantage to fundamental investing. And if you think about earnings power value, if part of those cash flows are coming from excess returns, then you have to think about the stability and duration of the company's competitive advantage. Otherwise, that part of the cash flows will erode away and you cannot value. Very important. All right, so in 1993, Bruce was dragged to the Murray Lectures, and this is his famous quote, but he was very impressed by the way Murray laid out this value investing. Bruce would tell you that he always thought he realized then he was always a value investor. He just didn't necessarily connect with the discipline. And after that, he came back and he convinced Roger to come back one last time to the classroom. In the fall of 93, they launched what is originally it was a value investing class. Now the Legends class is really the offspin. And Jenny Wallace had the opportunity to sit in that class. And at the time, James Pan and Jason Lederer were in town and they got to go to some of the lectures. So it was kind of cool connection there as well. What they did is they had this course where the first four lectures first four classes were lectures, 2 from Roger and 2 from Bruce. And then they had a series of speakers come and talk to the students. Pretty impressive list. As you can see, put a pin in that. We're going to come back to that momentarily. Right, here's the whole history of Heilbronn. Heilbronn gets started in 1984 as a gift from Barbara Dodd Anderson, who was David Dodd's daughter. And then since then, many other people have contributed. It's had certainly led the field on establishing events and other things related to value investing. It's been the key. All right, this tonight, we had 16 submissions from mostly second years at Columbia Business School. And as Jenny said, it was I think the most competitive we've seen, probably the best across the board, both ideas and write-ups, which just, I think, is a hallmark of how great the school has become. I often joke that Columbia has the best investment program in the country in terms of curriculum, but it's an easy bet because almost no other school has any courses, and we offer something like 35 courses, so it's like 35 to 0. Pretty cool. We did get the 4 finalists today, and they'll present today. All right, this is why I said how many years, it depends on what you want to count. This whole event starts in 2010. In honor of a guy named Moon Lee. Moon Lee was a very young, very passionate, extremely generous, very humble investor that died at a very young age. And he worked for a guy named Alex Porter. And Alex thought it would be, in honor of Moon Lee, he would start an event. He came to Columbia Business School. John Freeland, who had graduated here, worked with Alex, and they came up and they started and they ran the program for 5 years. And then Alex died. And so they changed the name from Moon Lee to Amici Capital, because that was the name of Alex's firm. And that ran for 1 year, and then sort of the interest died, the momentum died. In 2017, Jeff Holm, who's one of the judges today, single-handedly brought it back. And he wrote all the checks, the money at the end, he did all of the work. And it's 2017 that he reached out to Paul Sonkin, and then Paul reached out to me to get involved in all this, as well as James Pan. So, and Jason, we decided Jason was about the same time. So we did one event, and then rather than how he did one event, we did one together. We decided to put the event in the hands of the students. So it was a SEMA event for 2 years. And then we dragged Dave Samra into the picture because we convinced him to write some checks. And so in honor of that, we changed the name to the Artisan International Value. And then after 5 years, he said, Paul, this really should be at the school. And so last year it found its proper home with the Heilbronn Center. So this is the second year with the Heilbronn Center, as you'll see. Now, this is, to me, really interesting. As I got to know all these people, out of a casual conversation, Dave, Jason, and James told me, oh, by the way, we were at the Murray Lectures in 93. And I was like, what? And then they started talking about it, and they were really the ones that pushed to bring value investing back to Columbia Business School. Other efforts were going on. Some alumni were involved. There was some fundraising going on. There was some courting of some people that were the case. But back in 92 and 93, these 3 people really pushed to bring value investing back. So part of the reason it's here is because of that. And they pestered the dean to bring it back. But one of the things that I want to point out is that they had colloquial, they had investors, come talk to the student. And you go look at that list. That list is very similar to the list that Bruce brought back when he launched the Legend program. So it goes all the way back there. So this, for me, that history, those relationships, people have known each other for 30 plus years. They've stayed in touch. They help each other out. They talk about investment ideas. They source ideas. They kind of remain sane in this crazy business with each other. So that, for me, is why the event is so powerful. And the key here is, so I just talk lastly, a couple of things. So Jeff Holmes here, he historically never really had a formal relationship with Columbia Business School, but if he hadn't written the check in 2017, we wouldn't be here tonight. So that was just pure respect for Alex Porter, his connection with Columbia, and that got it started. He brought in James Pan, who he'd known for a long time from the business. James brought in Jason because they were connected, who brought in David because they were connected and known each other for a very long time. James knew Sonkin, and if you later ask James Pan how he met me, it's a pretty funny story. And then I got involved, and then we brought in Jenny, who, by the way, took Bruce's first class. So the people that are judges tonight are judges. They're very good investors. They're great judges. They're giving an enormous amount of time. But more importantly is they're really the history of the event. And that, to me, is really the key. One final comment I have to say for my partner in crime, Paul Sonkin. We wrote 2 books together. And that is that little known fact is he was my TA. He was my student. He was my TA for a couple of years. He then started teaching. He invented a course called Applied Value Investing. So you have tremendous amount of history among these people that are presented to you as judges, when in fact they really represent the modern legacy of value investing at Columbia Business School. And with that, they're going to give me the hook. All right. Thank you very much. We have one more judge. Another Jenny, who I think we met for the first time last night. I don't think we've ever met before. And she is also a professional investor with a spectacular track record and a long history. And another person who's volunteering. There is no pay. There's no anything else. They're doing it because of the love of the business and the desire to give back to the students. So I think all of our judges, round of applause before we get started.
So thank you for supporting this competition, and thank you for choosing me to talk a bit more about locks and door closers. I'm presenting Dormakaba as a long. I think it's worth 106 Swiss francs per share, which was 72% upside as of Monday, and a smidge more today. Dormakaba is an underappreciated player in the lock and access control space. Investors tend to focus on the 2 largest players by market cap, whereas in the industry, this is one of 3 default go-to brands that specifiers have top of mind. Given Dormakaba's relatively high exposure to electromechanical and stable mechanical business, the through-cycle growth guidance and market expectations look conservative. I also think electromechanical and connected access control increasingly create an additional monetization opportunity to harness more profit on the back of existing sales and customers. Thirdly, there has been a meaningful management change that's been put in place that I think can unlock value. This business is getting better and better, even beyond a 3-year investment horizon, and the shift in the business composition has been overlooked as the market has likely focused on the management turnover and a decade of weaker execution at Dormakaba that has only recently been stemmed. Just to put everyone on the same page, Dormakaba sell the mechanical hardware, including locks, doors, and parts you'd find in the entryways of a typical building. These are some photos from a trade show I attended and have the 2 staple products. So the lock set and the humble door closer. And at the bottom corner, you can also catch a peek of a subscription plan. These have all been becoming increasingly smart and connected, with the pace of change accelerating, as you can see from one industry journal I was handed at the trade show. This is a stable, recurring business in an attractive industry. The top 3 players have been steadily gaining share against the rest, and there is a lot of repeat and less cyclical non-resi business, as new build is a lesser focus at Dormakaba. This leads to high returns. The catch is that this is a former activist engagement. As a brief bit of history, Dormakaba was formed through the merger of 2 family businesses, Dorma plus Kaba, and then went through a period of value creation with an activist investor. The stock slid back down after missing targets following the merger, and then had a series of troubling CEO changes with a new person every year for 4 years. So Dormakaba is now still on sale, even though the last one has been in place for 2 years, and looks like he's steadied the ship so that Dormakaba can benefit from the favorable industry tailwind that is in progress. I was pretty keen to work on this project because it seemed clear there was a good chance to reach a variant view. As you can see in the top right, Dormakaba is much less liquid than the other players and has inconvenient disclosure if you're trying to compare apples to apples with a semi-annual disclosure and a different year end. Another key point is that the IR team admitted that the trend towards electromechanical has perhaps not quite moved as quickly globally as they predicted 10 years ago. There's also a high family ownership. It requires some creativity to get to the most important underlying trend of the business. And few sell-side analysts cover all the names in the sector since they're listed in different countries, which I think is indicative of the general level of interest. My work suggests Dormakaba's guidance is too conservative. They also admitted that they're keen to regain investor trust. So what might be happening is we're getting weak guidance while Dormakaba can quietly outperform the other two major players. To keep things simple, what you can have in mind for now is just over half the business is mechanical and just under half is electromechanical. On the mechanical side, we're talking about a history of very stable price realization. Notably, this performance is amid price competition from private peers, and all three players talk about 1% to 2% annual pricing going forward. If Dormakaba can continue to generate this 1% to 2% pricing growth, plus a couple of percent of underlying volume, it can already take us to basically the guided range using the slower portion of the sales. Now, this is the more exciting part. Dormakaba say that on a like-for-like basis against the others, they have the highest exposure to electromechanical. And the two key insights I want you to take away is that 80 to 90% of new construction projects could be electromechanical now for the top three players. And penetration is still quite low, leading to a long runway for growth. I'm going to show you 3 ways to get a handle on this electromechanical growth. First, looking internationally, Assa Abloy disclosed granular organic information for the first time a few months ago, and it's clear that electromechanical is growing at almost 10% a year for them. So this is a business that's going to become a greater proportion over time, and if penetration is still low, it's going to pull up the average for several years. In addition, subscription sales, which are an undisclosed amount for Dormakaba, are growing very fast. And the reason for this is because you can generate a further $1.50 for every dollar you're already selling through the software, subscription, and additional maintenance that a connected lock or entry solution requires. Here's my attempt to think through how it works as simply as possible. So a mechanical lock has a lifespan of, say, 8 to 30 years, depending on exactly what kind of building it's in and end market. You get maybe 2 years of warranty, and then you need to service the lock with parts. What we're going to see now is you have a lock with an average selling price that can be 4 to 5 times as high, that has more moving parts that can go wrong and need to be serviced, and also where the lock company is getting a cut of the subscription fee so that you can use an app to open your door. To give one example, I live in one of Colombia's newer graduate buildings, and all the doors are operated through an app or a card. My building manager explained to me that Colombia is paying for a set of access tokens annually for us, which eventually can get factored in as rent. And for a building where residents change regularly and lose their keys, this ends up being worthwhile. So in short, a huge opportunity to make money at perhaps close to a software margin. So that was the bottom-up analysis on a given lock. And as you can imagine, the current penetration and potential penetration start to matter a lot. Anecdotally, South Korea is a great example of a country where penetration could be as high as 90%. And from a top-down analysis, it doesn't take crazy numbers to get to mid-teens growth for this half of the business. This quickly impacts the margins. So to complete this unit economics from before, you can see that the total value over the lifetime of the lock goes up a lot, but so does the margin. Servicing and repairs are probably higher margin than the average business, and software could be even more profitable than my guess here. When you talk to people in the industry, it's clear that the non-resi business, where Dormakaba has the most exposure, is where you can get this aftermarket and margin potential just based on the nature of a multifamily or commercial building. Apart from this higher exposure and being out of favor with the market, Dormakaba faced a series of executive changes. So Till Reuter is the first CEO who is operating without the direct influence of the former chairman. And although it's just a short period, performance has been improving. Although he's not a lock expert, an industry veteran who's been in locks since the 1990s made me think about this in a different way. So Till Reuter previously had a reasonably good track record at KUKA, compounding key metrics at good rates. And KUKA is a robotics and automation company, which is close to where this business is going. And there's also a precedent. So two of the previous CEOs at Assa Abloy were industry outsiders coming into the business and coming from an industrial machinery type business. What really locks this in is Dormakaba are thinking about and discussing their incentive structure with more transparency on the KPIs. So combined with an executive and two families who own shares, this looks like a promising setup. Putting all of this together, this easily becomes a business that can grow quite a lot faster than what consensus is expecting and what is priced in. I want to just quickly highlight four ways this can go wrong. So one is building management systems are becoming more advanced, and perhaps another part of the building that's a more important part of the budget can start to influence the decision on the lock and access control. This is a real risk. The reason I'm not immediately worried about it is because this doesn't necessarily happen overnight. And what gives me confidence is that locks and entryways are an entirely separate part of the specification manual. And the customer and even the customer's architect outsource and rely on this decision on a separate expert. Then it's unclear whether the R&D advantage built over decades is transferable to electronics. The new management team and family can destroy value with their decisions such as M&A. And if electromechanical penetration is really a lot higher than what I'm estimating and heard from the trade shows, this kills one leg of the growth. But all of these things are researchable, and I would do more analysis with more time. What I think really matters here more is you're getting a 2-to-1 risk reward for a business that has generated pretty good economics when it has operated below its potential, looks like it's underfollowed, and is getting even better if you're looking to invest over a longer window. Looking forward to take your questions. Go ahead.
In South Korea and China, are these three companies involved? And if so, what are their market shares in South Korea and in China?
I think South Korea has a local player that is the number one. But Dormakaba and Assa Abloy have more exposure to Asia compared to Allegion, if I remember off the top of my head. And I was just trying to get to this slide. So kind of for Dormakaba, Asia is in this kind of rest of the world category, which is meaningful. They don't disclose specific statistics on exactly that market, but one thing I do know is that Asia is obviously a bit more competitive and less profitable for these players.
Are any of those companies in the Western markets?
I don't know off the top of my head, but I assume you can buy lots of private, unbranded Chinese locks. The one thing I heard when I talked to people in the industry is like kind of your access control and your entry point to a building is such an important part for your perceived security that historically, like a brand like Yale, which Assa Abloy used to own in the US and had to divest, was something that people kind of really valued and ended up being kind of the default choice for the average building. Go ahead, James.
What was the enterprise value to revenue again?
Yeah, so the enterprise value is slightly tricky for two reasons. One is you have quite a complex family ownership that I wanted to go to. So on Bloomberg, you get $3 billion worth of EV. But if you adjust for this 45% economic interest that Dormakaba's family have, sorry, this was the slide I was going to, you actually end up with a much higher number. So it depends where you're going with this question, because I think the look-through true value of the EV, either you need to adjust up or you can take out some of the profit.
What's the sales for 2027?
One moment. For 2027 or 2028 is my end.
Well, whenever you get to 17% margins.
Yeah, 1 second. I'll give you the exact number, which is here. So I'm talking about 3.4 billion
So you're
CHF.
talking about like two and a fraction of sales.
Yeah, which actually falls in the range. So M&A in the space falls between sort of 2 to 3 times EV to sales, usually, or 12 to 18 times EBIT. And I mean, I can talk more about how I came up with the multiple too, if that's what you'd like.
If you could talk a little bit about how you get to that margin, what is the incremental margin you come up to? How does that comp to the competition? What sort of scale do we have relative to the competition? If we could start there. And then my second question is about the family and the activists, because if the family in combination owns 45% of the company, how could they possibly have let in an activist who changed the CEO 3 or 4 times over the last few years? It just seems like that would not be in the long-term best interest of a committed shareholder.
Yeah. Okay, let's talk about maybe the margin first. So I think in my main deck, it was the best way to show it, actually, which was here. This is the USD sales value for FY24, but with the caveat that Dormakaba is always 6 months ahead of the other two. So Assa Abloy is always, a lot bigger than the next two players in this 33% share. The other slide that I had quickly showed, but want to come back to, is just this revenue share over time, if I can get there. Which is here, which is showing that kind of Assa Abloy's advantage has been sort of stabilizing and kind of on the organic growth numbers, Dormakaba in the last 2 years has actually been outgrowing both of these other two players. So Assa and Allegion, they have higher margins than Dormakaba. I think Allegion's EBIT margin is like 20%, but they have a much higher skew to US business, which tends to be a more profitable business. So just to give you a sense, I think Allegion, I don't remember the exact off the top of my head, but Dormakaba is much more focused on, they have more Europe and Asia. Assa is about 30%, and Allegion is half of that. And then the Asian exposure of Allegion is like 15. So we're talking about Assa, I think, with 45% in the Americas and Dormakaba at 30. So there's a bit of scale in each local market, but also the actual structure of the markets are a bit different, with the recent kind of focus at Dormakaba going there. That said, the other part that moves the margin is Dormakaba have these several cost-saving initiatives. So they're targeting going from what was, I guess, like a 14% adjusted EBITDA margin to 16 to 18% by FY 2026, which would be this June. And that comes from the cost savings and is unrelated to the overall structural mix of the profitability that I was trying to describe in electromechanical. Then you had this question on the management turnover. So I obviously, I haven't followed this company for that long, but I got the impression that the previous CEO who became chairman in 2021, he was the CEO of Kaba before the merger of Dorma and Kaba. And he was someone who was chosen and trusted by the family. But in his time, margins basically collapsed and total shareholder returns for the minority shareholder were very weak. So he's someone who was phased out, and they brought in Sabrina. It's a bit unclear, but she was poached by another company who took her as their CEO, a bigger US listed company, I believe. And then Jimeng Li was an internal promotion from the Asian business. I think he was president of Asia at Dormakaba and was seen as someone who could take over. But it really looks like having Ria Cadeno in place as chairman meant they weren't able to necessarily fulfill what they were hoping to do with this business and took other opportunities until Reuters.
And have you spent any time looking at the family, their control structure? What are their goals and objectives, and why they ended up with this sort of internal dysfunction?
Yeah, I mean, it's a bit difficult to do really full-on due diligence on them because it's a combination of at this point 3 or 4 families. So you have the Dorma family. It's actually 2 families. It's the Dorkin plus Mankell family, who now have partially married into each other, and then the Kaba is another set of families, and together they own this pool of interest that's committed to Dormakaba through 2030. So, I identified a couple of key people who are on the board. The most important seems to be Stephanie Bregman. She owns, she's the top one there. She owns a meaningful portion of her net worth in the stock. And, for all intents and purposes, it seems like she should be aligned with making this work. But, to try to answer your question of why have they allowed, 4 CEO changes, I'm not sure I have a good answer to that.
And an activist, how did that activist penetrate this control system?
Yeah, so look, I don't know the exact answer to that. There was an HBS case study from 2017 that I read about the activists coming in. They brought their proposal to the CEO at the time, who was most recently chairman, and I think he ended up being willing to listen to what they wanted to do. And some of it was about this merger and taking out certain types of business that were less profitable and lower margin. And one example that was brought up in this case study was sort of hollow metal doors that Kaba used to have a position in, and now it's less representative in the business.
And would you say that you would think about the valuation on a business with this sort of control structure in any different way that you might think about the other competitors, better or worse?
Yeah, I mean, look, coming in to looking at Dormakaba, I was quite hopeful that having a long-term family ownership would be a positive to try and think through and be aligned with what they want to do. Given the mixed history, it probably now deserves some kind of discount. I am valuing at a discount, and I am taking out kind of the family stake when I do my valuation. But that said, we're talking about ASA and Allegion trading at genuinely much higher multiples usually than Dormakaba, when really the quality of the business is probably similar. And I know every applied value investing section is a bit different, but for us, our central methodology was this EV/EBIT, and we were talking about sort of 10 times being fair for an average quality business with an average ROIC. Dormakaba clearly has a higher return profile than an average business, and in my opinion has this potential to grow. So I put it on 16 times EV/EBIT as my central base case.
Can I build on that? Great presentation and such an interesting company. So when I think about the biggest mistakes that I've made in investing, it's usually getting the management wrong and looking at a business and saying, this is a great business, like it'll be fine. But when you lay out this CEO turnover, I like that Peter Drucker, which who knows if it's really attributed to him or not, but that Peter Drucker quote of culture eats strategy for breakfast pops into my head. And then you said the new CEO has been in place for 2 years. So stepping aside from your presentation, do you really believe that 2 years is long enough for someone to be proven after what looks like kind of a dumpster fire of a cultural problem? Or do you think, well, I'm crossing my fingers, hoping to get lucky, there's already a discount, but the reality is in your gut, you need 6 years before you can say, hey, this person actually has the chops to reposition the strategy and get it on track?
So I don't have a precise answer on how many years he needs to prove himself. He joined the board of Dormakaba, I think in 2020 or 2021. So he's been involved with Dormakaba for that period that, it looks like it's starting to turn around. That said, I agree 2 years is a very short period of time. He hasn't been in the lock space. And really what gave me maybe more conviction to bring this and present this was when ASA and Abloy merged in the 1990s. You also had an executive come in who had no experience in the lock-making space, and that's become an extremely successful business that's highly regarded and sort of well documented. So my hope is this is a parallel. I'm paying a multiple that's lower than what the market demands for ASA Abloy. And I just think that the underlying kind of structural opportunity is really there, and the difference between, I guess, why this opportunity exists and the one in Allegion and ASA might not is because they're more fully priced, and that comes with being willing to take the discount risk.
Is the sales underperformance representative of lost market share, or does it have to do with organic growth versus acquisition-led growth? What is the nature of that? And are there things that this company needs to do in order to start at least performing in line with the industry?
I think it's difficult to answer this question holistically, but basically you had a period from after the merger in, say, 2015, 2016, up until COVID, where Dormakaba seemed to be going through, this cultural integration mess where salespeople were incentivized in, not the optimal way. They were lagging behind the other two, and they weren't necessarily able to get exposed to the business areas they would want to. So one example is Dormakaba was a late entrant into data centers, which I think for Asa and Allegion is potentially 1% of sales today, growing very quickly, and something they were behind on. But that said, the end market skews are just quite complex to untangle for all three of these players, especially when you add in geography and I don't know, for example, Dormakaba anecdotally are stronger in the airport business, which, at different times may or may not be interesting or not.
Can I just ask you, you've done a great job laying out the elements of this. How do you think it gets revalued? Is it the CEO's impact? Is growth, revenue growth faster, or margins inflect faster? How do people come to this and say, how does it reach your target?
Well, I think it's partially about the growth that you're mentioning, because basically for the last 2 years, Dormakaba has been ahead of the other two. And I think, if that persists for 3, 4, 5 years organically, people start to question why is that the case? And the reason that would be the case if they're genuinely more exposed to electromechanical, and that starts to really take off. And for me, I realized that this electromechanical thing is happening was when I lived in Geneva, Swiss city. My building had Dormakaba, and we had a mechanical lock on the front door, and eventually they replaced it. You got sent a text message, and you could sign up to pay, I think, 10 francs a month to be able to, see someone in the doorbell, or otherwise you'd keep using the mechanical solution. So that's a genuine kind of nonlinear change that, benefits Dormakaba in that country. And if they're exposed to it and it brings higher margin business in this non-resi area, it will come through in the margin as well. Thank you.
Thank you.
Good evening. I'm Elsa, and today I'm pitching Lululemon. While the broader market has been hitting highs, Lululemon is currently experiencing a Black Friday sale of its stock. I recommend a buy with a 2028 price target of $368, representing a 91% of total return as of Monday. Using today's closing price, it implies a 114% total return. I hear some laughs, so why talking about Lululemon at this moment? Lululemon is a category-defining brand with high-quality, cash-generative operations and a meaningful growth runway. Despite this, the stock price halved last year, bringing its valuation to historical lows. As of Monday, Lululemon trades at 15 times forward PE, significantly below its 5-year average of 22 times. Its ROIC remains 30%, proving the brand's health may be better than the stock chart shows. To understand where the company is going, let's take a quick look at the current business. In 2024, the business was 61% US-based and 63% women's, and there is very limited wholesale. The international markets and men's categories are growth opportunities. My thesis rests on 3 variant views where I believe the market is too pessimistic. Firstly, North America comp sales will rebound to 3 to 4% in the medium term. Secondly, international markets offers a double-digit growth runway for the next decade. And lastly, current margin compression is due to fixable external shocks with additional support from a better mix. Note that the fast-growing China business enjoys a better margin profile than the US business. Firstly, on North America growth reacceleration, why did comp sales in the US turn negative in the first place? It comes down to three things: a slowdown in product innovation, a gap in creative director leadership, and a tough external retail environment with negative 13% luxury retail traffic last year. These issues are fixable. The new creative director, Jonathan Chen, who was credited for the resurgence of Levi's, is going to deliver his work this spring. In addition, activist involvement from the founder, Chip Wilson, and Elliott is going to push a new board and in search of a new CEO. My survey of 141 Columbia Business School students confirms that Lululemon still has great products. 72% of respondents rated Lululemon for best comfort and performance, and 85% rated it for best design. Based on Earnest Analytics customer retention credit card data, Lululemon's customer retention rate is double that of Alo's. Lululemon still leads in the product innovation with 40 material innovation scientists and specialists and over 200 million product innovation investments annually. That's more than 20% of Alo's annual sales. By 2028, I expect North America comp sales to recover to 3 to 4%. That's in line with overall sportswear industry growth and modestly better than those fashion-driven retailers like American Eagle. In the brand space, comebacks are not unusual. We have seen recent examples in Coach and Abercrombie & Fitch, and we also have more old cases with Ralph Lauren and Louis Vuitton. Let me now turn to my second thesis, international growth. China is a big opportunity. Store penetration is incredibly low, just 0.2 stores per urban population compared to 1.3 in the US. Compared with the local brand Fila, which has more than 1,900 stores in China, Lululemon only operates around 165 stores in China. Based on my triangulation from different methods, it can more than double its store counts in the next 5 years, sustaining double digits store count growth. And this is not just a China growth story. Across 19 rest of the world markets, Lululemon operates only 161 stores today. There is potential to triple the store base, which translates into roughly a 13% store count CAGR in the next 10 years. The international growth potential is huge, and under International President Antti Massatrini, Lululemon is unlocking this potential. Feedback on his leadership is really favorable, and the 2026 Be Spring campaign featuring Yo-Yo Ma is a prime example of elevated and localized marketing. My final thesis is margin recovery. The 390 basis point EBIT margin decline in 2025 was driven largely by external factors, particularly the end of de minimis exemption and tariffs. About 2/3 of US e-commerce orders of Lululemon are fulfilled from their Canadian warehouses, which are now subject to higher tariffs, around 30%. Management is actively mitigating this through distribution center optimization and vendor negotiations. Looking ahead, I expect EBIT margins to recover to 21.5% by 2030. While Americans' margins will remain below prior levels, overall margins improve on favorable mix, as the fast-growing region China has a better margin profile than the US. My variant views translate into an IRR bridge of around 25%. The major drivers are revenue growth, margin recovery, share repurchase around $1 billion annually, and a modest multiple re-rating. As of Monday, Lululemon trades at 15 times forward PE. To put that in perspective, the 3-year average is around 20 times, and the 5-year average is around 22 times. We're essentially at a 5-year valuation floor. I've also run a PE regression of 24 sports and apparel brands based on growth and ROIC. Lululemon is well below the line. Based on consensus numbers, Lululemon should trade at 20 times to sit on the line. In my base case, I see a 91% total return as of Monday. Even in a bear case where US growth stays negative for the next 3 years, the downside is limited to negative 21%, as the current stock price reflects extreme pessimism. Lastly, it's clearly a turbulent period for the stock and the company. There are risks, including the possibilities that the new styles fail to resonate, product quality issues reemerge, governance disputes persist, or competition intensifies. I'll be closely monitoring all these issues, the February spring product launches, the ongoing de minimis solutions, the CEO search, and the upcoming board nominations. In conclusion, Lululemon is a premium brand trading at a discounted valuation. For investors who believe in the brand's resilience and its international growth runway, today's valuation is near the bottom and offers margin of safety. Thank you. I'm happy to take any questions. Yeah. Please.
Thanks. I guess a question I have, why have Alo and Vori done so well? And are there any kind of up-and-coming smaller brands that are out there or doing well?
Yeah, I think that's a very valid question because if you look at the history, like 10 years ago, 20 years ago, Lululemon didn't have a lot of competitors. They're the sole leader of that category. But nowadays, they're facing competition not only from incumbents like Nike and Adidas, but also from more and more emerging brands like Alo and Viore. Alo's sales is around 1 billion, so that's 1/10 of Lululemon's scale. I think its appeal mainly comes from several things. Firstly, it's like influencer marketing. They really leverage the superstars to capture the next generation customers, and they really spend a lot on their marketing and advertising budget. That's the first thing. And second thing is that the style. I think Alo's appeal to customers is that it's high fashion styles, and so it's kind of like the aspirational brand now. Saying all the good things about Alo, I think it still has some weaknesses. So first is that the product quality issues. If you go on Reddit or if you go on Instagram, you will see a lot of complaints on, oh, Alo is so pricey, it's almost the same price or like more expensive than Lululemon. Why the product quality is not there? So I think that's one area that Alo needs to improve. And I think that also translates to the low retention rate you have seen from my previous analysis. The customer retention is less than half of Lululemon's. That's probably because the product quality is not there, and also they're attracting a younger customer group. And Viore, I think their success mainly rests on their focus on the male customers. They're trying to provide those technical apparel and comfort clothes to the male customer groups.
What about smaller brands? Anything about smaller brands as well?
Yeah. I think, of course, if you go to the West Coast, you will see a lot of emerging athleisure, smaller brands. This is really because this industry is growing. And I have one recent notice. There's an incumbent brand called Free People, but they didn't do sportswear before. But nowadays, they have a new sub-brand called Free People Movement that is also entering this category. So yes, definitely more and more brands enter into this attractive category.
That was a great presentation, and thank you so much. So thoughtful. One of the things that I'm struggling with is multiple re-rating. And I feel like over the last 10 years, but really the last 5 years, we've gotten lulled into thinking that like this 20 times multiple is normal, right? And that 22 times is reasonable. And when we think about your projections on Lulu, and you've got these earnings growth rates of like 9-ish%, right? For the foreseeable future on average. And like, I wonder, and this is kind of existential for you, like, what is the right multiple? You know, setting aside history, because I don't know that historical multiples really apply. And that goes to Jason's question. Like, this whole athleisure space and sneaker space is so much more competitive. The barriers to entry are high, but not that high. It's easier to compete there. Like, what is the right multiple for something that's growing consistently at 8 times that has real competitive risk to it? Like, is it really a 20 times multiple? Or sorry, so what is something growing at 8%? Like, is it really a 20 times multiple, or does it only deserve to be 16 times?
Yeah, that's a really good question. So in my model, I forecast the growth next 5 year, the top line growth is going to be 8% CAGR. And in my base case, I'm using like 1 turn increasing multiple. So that's like 16 times for my base case. And the bull case is the 20 times you have mentioned. And I think that's a very valid question because the competitive landscape is very different. So I also use the DCF method to try to see what is the right multiple for this company. So in my DCF model, I have 3 stages. So the first stage is 2025 to 2030, and the top line growth is going to be 8%. And then the second stage is the next 5 years after that. I'm using a 7% free cash flow growth rate. And then the third stage is 2035 to 2040, I'm using a 5% free cash flow growth rate. And then the perpetual growth rate, I'm using the 3%. It's like the sportswear industry growth rate. And using a 8% discount rate, this will lead to stock price targets of 380. So that's very similar to my base case target. So I felt like my base case multiple makes sense.
Can I ask one other thing on that? Because all of these growth targets, I think, are kind of presuming a status quo state of the U.S. consumer. And I know a lot of your growth expectations has to do with China and international, so maybe this doesn't apply. But one of the things that we're seeing is we're seeing real softness start to creep in the U.S. labor markets. So, like, what if the consumer does weaken? And what if that 3 to 4% growth rate from the U.S. consumer, like, what if that doesn't continue? How much does that impact your price target then?
Yeah. I think that's a very good question. So maybe to do a simple calculation based on this IRR bridge, you can see like the 8% revenue CAGR, like 40% is come from North America. So let's just assume it's 0. Lululemon cannot grow its North American business anymore. Then that 8% is going to be like 5%, 4 to 5%. That's 100% based on the international growth. So I think the total IRR will decrease to around like 20%. Yeah, that's to answer your question. So my point is that nowadays Lululemon has like more than 25% revenue from international markets, and this piece of business is still under-penetrated and has a long growth runway. It's not a 100% U.S. story.
Can I just jump in? Question, you mentioned share buybacks. Has management indicated, I know there's flux right now, but has management indicated their plans for the capital allocation and deployment, continuation of buyback or any of that?
I think one data point is that last quarter they mentioned that they will have a new $1 billion shareholder buyback program. So I think that's a favorable gesture that management is noticing the pains of many shareholders.
Got it. Okay, thank you. And then a second question is this sort of existential risk around the material, right? On the one hand, you know, Lulu is blaming customers for getting the wrong size, for material being see-through. That does not win you many friends. Additionally, there's the risk of the toxic chemicals in the actual fabrics. Is this something you've looked at? And I guess you could say maybe this is a U.S. problem and could argue simply for saying there's no U.S. growth. But I'm curious if you've thought of these two issues at all and kind of how you factor them in to the forward-looking for Lulu. Thank you.
Yeah. I think the first question about the material, because they recently launched a new product called Get Low. It's a training leggings and also bra. And some customer complain that it's 100% see-through, so you cannot use it for training. I tried the product in the Columbia University's Lululemon store. I felt like it's not see-through for me, but definitely the style is not very flattering. I don't particularly like that innovation. And I don't think their response it's good enough, because they have pulled back the products for several days, and now they still have they put the products back and advise the customer to wear underwear of different color to make sure that it's not see-through. I felt like this is not the best way to deal with the product quality or like unfavorable comment of their product. They can actually do better. But I think we have seen this movie before. Like in 2013, there's a big product quality issue, and it's also the pants see-through. So they record several millions of products, and they recovered from that issue. I think the key takeaway is probably that they really need to put product quality and customer feedback at the center and refocus on product innovation. That's the first one. And the second one on the possibility that the chemical and the material is toxic. I haven't looked into that, but I think it's very good questions. I'll take a look later.
Thank you for the presentation. Could you talk about the customer a little bit, sort of the main target customer for these products? Have you looked at other products that are sold to that target market, the penetration of those other products, the duration, the durability of products sold to that market, just so you can sort of handicap the sustainability of the product? And then in terms of their growth in China, which seems like a pretty interesting part of the story, can you talk a little bit about the way that these products were popularized in America and whether or not that same playbook is being used as they try to grow that business in China?
Great questions. So firstly, on the target customer, I'm going to steal from the founder, Chip Wilson. He described the target customer in his book. The target customer, her name is Ocean. She's around 30 years old. She is highly educated, and she has a successful career, and probably she's not married, so she has a lot of time to take care of herself and do exercise. So that's the customer Chip Wilson described in his book. I think it still makes sense nowadays, but of course, Lululemon has expanded the customer from female customers to male customers. And when we talk about the penetration and durability, so firstly, Lululemon's market share, Lululemon sportswear market share in the US is 3.6%. That's still far below Nike's 11% in the US. And as a reference point, its market share in Canada is more than 15%. That's one reference point. And the other thing is that are there similar brands this customer groups purchase? I think from reading the Reddit posts and from reading the Instagram, I felt like Lululemon customers also like Ralph Lauren or like similar affordable luxury brands. I felt like, for example, Ralph Lauren has a much longer history and it has a comeback of the popularity. So there's some durability there. And then your second question on their growth in China, I think they're using the similar playbook. So that playbook is that you have a 100% DTC model. You have 100% control of your stores and channels, so you can have good store experience. And secondly, you really rely on brand ambassadors. You really rely on localized marketings instead of you have those very high profile like Olympic sponsorship. So I think the playbook still works in China and is in an early growth stage, so the growth is explosive.
But is the customer in China, is there a lifestyle of athleticism and kind of casual apparel and all of that in China? Is there the chance that that woman ocean exists in China?
I would say 100%. Yeah. I can see from my colleagues in China, they like to wear the products to work.
And then you had addressed the U.S. comps, and to me, that's what's going to make the stock revalue. You said the things you're going to be looking for, but what's the most important, and how's that going to turn? How are those U.S. comps going to turn up?
Yeah, I think that's the most important question. I think the company really need to refocus on product innovation, design products for athletes and its core consumers that has great athletic performance. I think over the last 3 years, they were not that good in product innovation. They relied on their historical successful product franchises too long. They haven't launched very successful new product lines. So the customers were like getting tired of their product a little bit. So I think going forward, they should be laser focused on product innovation to stay ahead of the competition. They have the scale, they have the knowledge. They just need to refocus on the product innovation. So I think a new creative director, a new management team, laser focused on product innovation could really help.
One more question on the U.S. sales. One of the things that kept Lulu's U.S. sales going was the limited edition of colors and the turnover. If you missed the teal blue, you missed the teal blue kind of thing. And so people bought right then and there. In my estimation, there's not that same sense of scarcity. Is that something that is needed in order to keep U.S. sales kind of consistent and growing, or what's your sense of that? Like, sort of, how do they get there?
I'm not a fashion designer, but from like reading the Reddit posts of like Lululemon OG fans and Lululemon educators and talking to a founding member of Lululemon several days ago, I felt like the partnership will be a way to create the brand cachet, like to have really successful partnership that also offer the scarcity is a good way. But I think the previous partnership with Disney was not a very successful one. I don't think that speaks to the core customers.
Thank you. Well, I have a quick question. Are the stores in China as profitable as the U.S., or do you expect them to be as profitable as the U.S. stores? How are the unit economics different in China than the U.S.?
1 second, I'm trying to. Yeah. This is not a store level data. I think I need to dig into the store level economics later. But if you look at the EBIT margin by region, so in 2025, China is 5 percentage points higher than US. That's mainly because of several reasons. One is that the product costs are lower in China because there's no tariffs. And second is because the SG&A it's also, the percentage of SG&A is also lower in China because of the local staff wages and management wages are lower in China.
Are the sales per store as high in China as they are here?
Because Lululemon, they don't disclose the DTC versus store sales by region. So I just have a estimate. Actually, Lululemon sales per store is the highest in the U.S. The U.S. stores are still the most protective. So I think the international markets, they have the growth of their store count and also the possibility to increase the store productivity. Thank you.
Hi, I'm Isabella. Thank you so much for the opportunity to present today. I will be pitching long Micron with a 2027 price target of $743. I originally pitched this name in my AVI class in November. Even though the stock price has appreciated since then, I still believe there is significant upside to the stock. So my investment thesis rests on 3 points. One, memory has become the bottleneck in AI as GPU memory requirements multiply. 2, the memory industry has shifted to a supply-gated model. And 3, Micron's earnings are structurally more durable than the market assumes. So just a quick company overview. Micron is a leading manufacturer of advanced semiconductor memory and storage solutions. It operates in a oligopoly alongside Samsung and SK hynix. And Micron is one of the 3 companies globally capable of producing leading-edge HBM, NAND, and DRAM, and it is the only one based in the US. In terms of a product overview, so their main products are a DRAM, which is basically high-speed volatile memory, 2 NAND flash. It's non-volatile memory used for long-term storage, so you can think of it as the type of memory used in your USB flash drive. And HBM, which is really the memory that is designed for data processing in GPUs, and it offers significantly more bandwidth than conventional DRAM, which is why it's used for GPUs. So my thesis number 1, memory has become the bottleneck in AI as GPU memory requirements multiply. So modern GPUs require enormous amounts of high-speed memory in order to function, to feed their parallel processing cores. And without sufficient bandwidth, performance collapses. So not only is it a necessary aspect of the GPU architecture, if you look at GPU memory demand, it is steadily increasing. So for example, the B300, which is NVIDIA's 2025 GPU model, it requires 3.6 times the memory that the H100, which was the 2022 model, requires. So not only is AI memory demand increasing, but the supply simply cannot scale fast enough to meet this demand. So Micron, SK hynix, and Samsung are all investing into either building out the capacity of their existing fabs or actually investing in new fabs. And although they're all making these investments, the lead time in order to kind of build out these fabs and also get them production ready takes years. And so the most meaningful capacity additions actually won't hit the market until 2027 to 2028 or later. And these additions will not help the 2026 tightness in the market. So because of the supply constraints, it's actually translating into pricing upside. There's confirmation from both upstream suppliers and downstream customers, which points to a tightening memory market and sustained pricing pressure. So since November, there have been news articles detailing how Samsung has increased their memory chip prices by up to 60%. I spoke with a semis engineer at a tech company focused on defense. And they said that because of the shortage in memory, their team is willing to pay double, and still they cannot get the amount of memory that they would like, that they need. So it's really, even with these high prices, it's still not clearing the market. And in a recent article by Forbes, at the 2026 Consumer Electronics Show, HP and Lenovo were showcasing their new laptops for the year. And when pushed on what the final price for these laptops would be, they could not give a firm answer because they said that they admitted it was because the memory inputs, the prices are still being negotiated. So it really is a seller's market, and given prices are still in flux, I think it is likely that we will still continue to see pricing increases. So this ongoing demand-supply imbalance will likely continue past 2027. So Micron Technology has stated that they expect the HBM market to reach $100 billion by 2028. Now, they actually pulled forward their estimate because originally they had expected to reach the $100 billion mark in 2030. And this market prior to 2023 was $1 billion. So within 5 years, it's going to scale from under $1 billion to $100 billion. Which will make it a major semiconductor category. And as total memory demand continues to expand through the decade, with these supply additions lagging, it's going to continue to support the sustained pricing strength of the suppliers and earnings durability rather than just a short-lived peak. Now, I feel like the Micron's advantages come from 3 points. One, it is a US-based memory supplier, and the US has made it clear that they would like the US to remain the leader in AI and advanced semiconductor technology. And although, previously the memory industry has been highly competitive, previous pricing wars have resulted in previous players going bankrupt to now, finally 3 players. And so any kind of, attempt by a foreign incumbent, such as Samsung, to kind of impair Micron or, go after Micron, I don't think would be tolerated by the US government. And then 2, their technology leadership. So multiple of the semis engineers that I spoke to have said that they view Micron as having a technology leadership. One of them being their due to their 1 gamma node technology, which basically increases bits per wafer, which helps increase output. And then because you have more bits per wafer, that's also reducing your cost per bit. And the other advantage lays in the power efficiency. So Micron was an early leader in bringing low power DRAM into server environments. And its HBM3 product is widely acknowledged to use about 30% less power than competing alternatives. And as the conversation about the energy and power consumption of AI data centers kind of evolves, I think Micron is well positioned on that axis. So in terms of valuation, Micron trades at its 11 times, it was 10 times as of Monday, which is far below the 22 times for the broader S&P 500. And my price target for 2027 actually assumes no multiple expansion. So it's at a 10x forward PE multiple. And lastly, why does the opportunity exist? So first, memory has found a new core function in AI systems. The HBM product didn't exist before GPUs. GPUs hit the memory limits of existing products, and now that GPUs and therefore HBM has found a core function in AI systems, I think it changes the overall view of Micron. And then 2, AI demand is committed earlier than supply can adjust. And because of the long lead times, it naturally leads to this shortage environment. And then 3, the market is still anchored to old cycles. So memory has historically been a short duration market. And so the market gives limited confidence to the sustainability of elevated earnings. But because of that, I also think because of the disconnect there, I also think that's where the opportunity lies. So with that, I'm happy to open it up to any questions. Thank you. Yes.
So on the PC side, it seems like there's a chunk that's the low end, and they try to configure it for a certain price point. They're trying to hit a certain price point. Do you think some of the PC makers will configure with lower DRAM loadings, or maybe SRAM loadings, or try to convert some of the SRAM to hard disk drive, at least for desktops, or possibly even notebooks?
Yeah, that's a great question. So it is a possibility, but the reason why you want to have the latest models or the best models partly is also because they have better functionality and speed. And so if you, if you kind of use the lower, quality products, it might impair, the speed or the functionality of the laptops. But for sure, for maybe budget laptops, I definitely think that's a possibility, and actually a really great idea for the PC companies.
In a world where NVIDIA's trading at 24 times and Apple's trading at something stupid like 30 times with only 9% growth, why are they stuck at 10 times earnings? Why is Micron stuck at 10 times?
Yeah, I think it goes back to, the market is anchored to old cycles. I've spoken to actually one semis engineer who spoke about how she got burned in the early 2000s investing in Micron, back when it was extremely cyclical. And I think the market is still kind of underestimating or the earnings durability. So I think because it's been so cyclical previously, they're still anchored to those, those old cycles. But I think because of how much demand AI is going to utilize, I think the earnings durability of this kind of, I don't want to call it a super cycle, but of this cycle is going to be different than previous ones.
You should frame the market for everybody. How much of the market actually comes from servers, PCs, handsets, so people can internalize that?
Yeah, I think, do I have that? I do. Sorry. Oh, back. So I don't have the exact for how it is for the entire market, but for Micron specifically, so cloud memory, this is your AI, your hyperscalers, they're about 39%. Core data, this is your enterprise data centers, and then it's right under 20%. Mobile and client, so this is your mobile devices, it is about 30%, and then automotive and embedded, so the automobile companies and then also industrial companies is 13%.
And given that the acceleration of demand is really coming from hyperscalers, it's pretty easy to follow their capital spending plans.
Yes.
Can you talk a little bit about what's happened from 2025 to 2026, the sustainability of that spending? Can it meet the objectives that you've laid out in your model as it goes forward?
Yeah, definitely. Great question. Yes. So I don't have numbers for the kind of the full market, but Meta recently announced earnings, and they had announced during that they're forecasting spending of at least $115 billion this year for 2026, which is a significant increase because last year I believe their capex was around 75. So this is almost, and the 115 is the low end. They had guided towards even to 135, so almost double the capex spend that they were spending last year. So this is just Meta, but I would guess that most of the hyperscalers are going to also go in that direction.
And what does it mean for the free cash flow generation of companies like Meta and Google and Amazon and Microsoft as they scale this up? Can they continue to do that? Are they getting enough growth in their underlying business to afford this type of spend?
That's a really good question. So I unfortunately didn't look so much into how this would impact Meta, but I can definitely look into that and kind of get back to you. But obviously, given more capex spend, that lowers their free cash flow. But it's definitely something I will look into and get back to you.
And as we move from training to inference and we start to use different types of chips,
Yeah.
what does that mean to the forecast for a $100 billion market? Does it start to change that dynamic? And is the CEO of Micron, does he tend to be conservative or optimistic over time?
Yeah, you're asking great questions. I know Samsung is one of your investments. So I know you know the industry really well. In terms of, Sanjay Malhotra, he's the CEO. In terms of their guidance, I would say their guidance typically is more on the conservative side. So this past earnings, they were they exceeded earnings per share by over 20%. And they guided towards originally 52% gross margin. They beat, they were 56%. So I don't think they are overly optimistic. And sorry, what was the first part of your question again? I want to make sure I address it.
Well, as you move from training to inference, and then there are all these new products that are proliferating. I don't know if you've done any work around, the Grok product that is designed to eliminate the dependency on HBM. How far have they gotten with that product, and will it represent a substitute because it uses SRAM, right? Have you done any work around that? And the price of memory is going through the roof, so people are going to start working hard to try to figure out a way around this.
Yeah, exactly right. So on the...
By the way, you've been right already, so take a little victory lap before you answer these ridiculous questions.
So on the inference point, I think now as what they're realizing is inference actually requires even more memory than training, and it's because of that, I think the demand, like you said, for HBM is going to increase. And then on your point about the Grok product, I have not done as much work on that, but it is definitely something I should look into and can get back to you on.
I just have a quick question. How do you think about the Chinese threat in DRAM?
Yeah, great question. It definitely came up in my research. So China is now trying to also enter the memory market. From my research, it seems that though they won't be able to get up to speed for production until at least 2027, just because they haven't they don't have the know-how or the technology right now. But it definitely could be a threat. But I think they would probably supply more to domestic markets. So within China, and China is less than 10% of Micron's current market. I don't think it's a huge threat, but it definitely exists. Yeah.
And in the future, how much DRAM will a typical Optimus robot or Boston Dynamics robot need?
Yeah. I think that's hard to project out, especially maybe based on what I've researched so far. But I did read that like autonomous vehicles are expected to require much more memory than we had originally anticipated. But I can get back to you on the robots question.
Can you go to page 14 of this? Where the pricing, where you have the pricing,
Oh, okay.
the out years, maybe it changed. You have a slide with the out year pricing for the 3 different product lines.
Like my
That one.
this one.
The one, yep. So I was just curious, how did you think about the pricing after this year? Because you have it growing.
Mm-hmm.
I mean, I think the bit shipments are somewhat visible. So I'm just curious how you thought about the pricing and how it would grow and grow again in 28.
Yeah, definitely. So in terms of pricing increases, for my rationale, even though there will be additional capacity coming into the market past 2027, I still think the pricing power is quite large as of 2027, just because you will have additional capacity, but really the really big chunks of capacity won't get added until probably 2030 plus. So, I felt like DRAM pricing, I felt like it was realistic to kind of assume 20% just because 2026 is so high. And then, it kind of goes down to a smaller number by 2029, just given as supply kind of comes into the market.
Back to Jenny's question about multiple. 10 is low in one way of thinking about it relative to the market, but 10 is actually kind of high for Micron. If you look at the long history of time, Micron often trades in a single-digit multiple range. Mm-hmm. And the reason is mostly because of the cyclicality. And so I take your point that there's been significant concentration, or whatever. The competitors are more rational. There should be less bad behavior on pricing. But when you get to the out years, when these fabs actually come online, what will the demand look like? Because that's when these stocks turn. They turn down hard on a forward look. That there is all of a sudden either sufficient capacity to meet demand or supply to meet demand, or going to be a little bit too much. Have you sort of looked out and thought about those risks?
Yeah, definitely. It's definitely, a key risk to consider is just the cyclicality of the company previously. But I will say one thing on the 10x forward PE multiple. Yes, you could say historically, it's traded at or below that. However, they're growing so rapidly. I mean, their earnings are, this year or just their Q2 guidance is going to be is more than what their earnings per share were for the entire year for 2025. 5. So just how rapidly it's growing, I think this pace of growth also, you could use that to justify. I mean, 10 is not. I don't think 10 is expensive, but you could use that to justify like a slightly higher multiple than like 9 times or whatnot. And then on the outer years, definitely it's a definite risk that once supply kind of comes online, you might see demand kind of collapse. And that's exactly why I moved my price target from 2028 to 2027 because of the visibility of the supply there.
Attempt to estimate normalized earnings power somewhere between peak and trough, and maybe try to put a multiple on that?
I should have. I looked a little bit at their peak and trough kind of. What their margins were and everything. I didn't go through that exercise, but that's definitely something I'll look into and get back to you on.
Thank you.
Thank you to everyone who came out tonight and our program sponsors. Echoing Paul's comments, it's nights like these that make Columbia and the value investing program really special and one of a kind. I'm pitching a long position in Sallie Mae. It currently trades at about $27 a share. I have a 2028 price target of $60 a share, so it's about 125% upside before any dividends, 30% IRR. A quick tangent, you might be wondering what's the inspiration for the pitch name. So one of the hit songs of the summer was by a band called Role Model, and the song is called Sally When the Wine Runs Out. Different celebrities would come up and perform with the band over the summer. So you had Kate Hudson and Natalie Portman. The man on the right, I would argue, should be just as famous. He's the CEO of Sallie Mae. His name is John Witter. And a little bit about Sallie Mae before we talk about Witter's transformation. Sallie Mae is the leading private provider of higher education loans. The company manages about $28 billion in assets and has a market cap of about $6 billion. In 2014, it split off from Navient, which is its historic servicing arm. It has 3 general higher education loan products, and it does about $2 billion in revenue, mostly from net interest income, but a little bit from gains on sale. Sallie Mae transformed radically under Witter. He reinvigorated it by simplifying operations, prudently allocating capital with a high dose of buybacks, and strengthening its market position. Since Witter joined, the stock has been a double. And however, the transformation remains underappreciated by the street, as it's gone from a quasi-government lender during this big COVID transition into a capital-light compounding machine. Why are we here today? Well, it's the passage of H.R. 1. Last year, Congress introduced significant reforms to existing student lending programs managed by the Department of Education. 2 key reforms in particular were the complete elimination of the Grad Plus loans and a cap on Parent Plus loans. Grad Plus accounts for about $14 billion in annual originations, and the Parent Plus program does about $12 billion in originations. So our investment thesis is that Sallie Mae is a financials compounder that's been underappreciated by the street. And we have 3 big points. First, we think there's upside from H.R. 1 that isn't priced in by the street, and we think that's closer to $6 billion than current company guidance of 4.75. Second, we think the delinquency concerns are overblown and investors are simply missing the forest for the trees. And third, we think the new partnership with KKR will be a major catalyst, as this partnership will unlock the opportunities for continued growth that's requisite for the stock's multiple to expand. On the right, you'll see that our returns bridge shows a pretty nice distribution between earnings growth, buybacks, and multiple expansion, and there's also a dividend to boot on top. The U.S. government has controlled most of student lending over the last 10 years. In a $100 billion market, the U.S. government has about 90% share. This is who Sallie Mae competes against. Amongst private lenders, it's a very different story. Sallie Mae dominates the competition, and current estimates indicate that Sallie Mae has over 60% market share. And as you see on the bottom, some of our VAR indicates if you did a poll of 10 borrowers on where they went to get their funding, Sallie Mae's name comes right after the government's. Against its private competition, Sallie Mae has kept growing market share. Though the private student lending market on the whole has remained relatively flat, Sallie Mae has continued to take share from peers. In the last 4 years alone, 2 competitors have exited the market, Wells Fargo in 2021 and Discover in 2024. Using trade association data, you can actually do some math and show that Sallie Mae has taken basically all of the incremental volume, over 70% and in 100% in some years. When you benchmark them against peers, Sallie Mae basically accounts for all of the growth in the industry when it comes to the private student lending market. Now, this is key because with Parent Plus and Grad Plus, there are a whole bunch of government loans that are about to come online. So there's a lot of numbers on this page, but basically what it is, it's a top-down analysis where the top section shows the growth trajectory of these general Grad Plus and Parent Plus programs, and the bottom translates that into the opportunity for Sallie. On the bottom, you'll see that we have 4 main factors: the conversion rates, eligibility, and Sallie Mae's incremental market share, which we've conservatively estimated at 65%, along with the growth ramp for these programs in the next 4 years. Putting that all together, you'll see on the bottom right-hand side of the page that we think that the opportunity is much closer to 5.7 to 6 billion by the time you get to 2030. So we're going to tackle the risks and mitigants in this stock a little bit early because the key controversy are these rising delinquency rates. In the summer, Sallie Mae was trading at about $33 a share. However, it's traded down about 20% from those highs due to elevated concerns about rising delinquencies. You can see on the page that these are all of the historic reported delinquencies going back to 2014, and it kind of looks like an up and to the right chart. But in the last 2 quarters, Sallie Mae has reported delinquency rates at 4%. However, our view is similar to the company's, which is that these rising delinquency rates are somewhat of a transitory issue. There's a number of one-time policy changes, along with the government restarting the payments on its own higher education loans. When you talk to the company and listen to them on their earnings calls, they've been pretty clear. In the last quarter, in Q3 of 2025, they started restricting loan modifications, and that change was purposeful. They've estimated that this change in loan modification protocols accounted for the recent rise, about 25 basis points of delinquencies. And then on top of that, if you have to consider that there's a general seasonal increase when you get into the back half of the year. In the subsequent quarter, delinquency rates have remained flat, consistent with other personal lending categories. So we have reason to believe that this won't get worse. Taking a longer view, we would say that the borrower quality for the Sallie Mae loans consists of somewhat of a narrative violation. Namely, I think people are frankly quite surprised when you tell people that the average borrower has a 756 credit score and 92% of these loans are co-signed. During COVID, Sallie Mae took major steps to improve its underwriting quality and has taken a relatively conservative approach to originating and dispersing loans. Moreover, as the company continues to expand into this Grad Plus lending tier and continues to pursue these gains on sale from the loan program, we think that the quality of the loan book should continue to improve. When you talk to formers, they'll actually say, wow, I'm quite surprised that the quality of the credit is that good. Ultimately, we think the delinquencies becomes a margin of safety question in a downside case. In our base case, we've conservatively estimated sort of roughly in line with the street at about 3.75%, so a modest improvement from where we were at the end of this past year. However, we've taken a more conservative approach in our downside case and are estimating delinquencies at around 5%, so it's about 33 to 40% higher depending on the year. As a note, Sallie Mae was not public during the Great Financial Crisis. However, delinquency rates on student loans during the GFC reached a high during that cycle of about 7.5% in 2010, just as a point of reference. So this downside case is somewhat of an in-between between where we are today and the worst recession we've had in the last 100 years. In addition, 2 other notes just on risk mitigation programs. From 2020 to 2024, the company committed over $1 billion in capital to risk mitigation through its CECL transition, which essentially commits more capital to borrower protection. And the transition ended in this past year. To our last point, we think the KKR partnership will be a major catalyst for the stock to re-rate. So historically, you'll see on the left that originations have been relatively flat because the bank wasn't sufficiently capitalized. This forward flows arrangement with KKR, and we're happy to get into the economics of that deal during the Q&A, will allow the company to continue to pursue this loan origination growth. We think this stock is a compounder, and we don't take that word lightly. but we think it's bound for a re-rating. So in our forecast, we show earnings going to about $4.27 by 2028 on the back of this loan growth from the Grad Plus program. And on the right, we believe that there's a pretty solid historical basis for the company continuing to buy back shares. Share count's been down about 50% since 2020 when Witter took over, and the company has authorized buybacks of $600 million, which is about 10% of their market cap. In our operating model, we have a 16% EPS beat over the next 2 years due to a minor top-line upside. But then in the out years, we see compelling and continued growth from the full ramp of the Grad Plus program. When you get to 2030, we think the stock is just objectively cheap at 4.5 times a share. In our valuation, we've looked at things on both a PE as well as a price-to-book basis. We think the skews are favorable in both. But what we would say is that a fair PE multiple for this stock, we think, is about 14 times, which is our bull side case, taking a fundamental approach. And then when you look at things from price to book, we think that the stock should trade at about 3 times. So in total, our price targets are $62 in our base case, $77 in our bull case, and 15% in our downside case that we $15 in our downside case that we outlined earlier. But at this point, we'll open it up for questions, and thank you so much. Yeah.
Oh, I have a question.
Sure.
Can we take a step back and go over the unit economics of the actual loan? How much capital do they have to put up? Are these the guaranteed loans? Like they're not dischargeable during bankruptcy? What's the spread? So if there's $100 of student loans, how much tangible capital does Sallie Mae have to put up? And what is the spread on that $100 loan?
At the dismay of some of our other judges, I'm just going to take you down the P&L for a quick second. So basically, Sallie Mae commands about a mid-fives net interest income spread on the loans that they originate. So the yield that they give out on these loans is somewhere in the ballpark of high 9s to low 10s, and the cost of funding is about 5.5%. So when you put that all together, the net interest margin, I think it's on one of these prior pages. But yeah, net interest margin, if you look at row 2, has been, if you look at that second category, has been pretty consistent at about 5.3%. Sallie Mae then has a choice fundamentally. They can either sell these loans immediately or keep them on their books. The loans that they sell becomes a gain on sale. And I have a page in the back in the appendix, but historically they sell these loans at about a 7 to 8% markup. And that just is EPS that goes right down to the bottom line. However, the trick with these loans is that...
Just assume they keep it all on balance sheet. How much equity do they need for that, to keep that loan on the balance sheet?
Sure. So there's a CET capital requirement. It basically is that they need to keep about 11% of book value for these incremental loan originations.
5.5% spread.
Can you repeat that?
G&A against that 5.5. How much G&A goes against that 5.5 spread?
I don't know if G&A is the right term, but basically when you look at it from a book value, they're sufficiently capitalized with
No.
$700
How much
million.
expense to run the business, to run all those loans, do you take off that 5.5?
Yeah, so right now G&A is $700 million. Last year it was $650. Next year they've guided to $700 million.
Okay.
Am I losing you on the borrowing
You don't
or
understand
kind of how it works?
the unit economics of the loan.
Can you elaborate on that, please? Are you talking about the
It's
provision
like,
for the
what's
credit losses?
Well, basically, I'm trying to get to how much equity to assets do you need to run this business without the gain on sale? Just assume that everything's on the balance sheet. What is the return on equity? What's the return on assets without the gain on sale? So when you look at a bank or something like a credit card company or something like this, it's the spread minus the G&A minus the credit losses, and how much equity you have to have against that.
Yeah, so the spread, they're doing $1.5 billion today.
Okay.
Right. So they're doing $1.5 billion in NIM today. Then they have, they're booking about $300 million in provisions for potential loan losses. Most of that is booked up front on the loan, and that's changed as a result of the CECL requirements. And then on top of the on top of the provisioning for the credit losses, they have another $700 million that they're losing on G&A. So when you take it down, I mean, you're looking at a business that seems relatively high, but then they also have to recommit about 40% of the earnings. And I have this on like a DCF kind of view on the back page, but 40% of the earnings have to get replowed in from net income back into the business in order to fulfill those CET1 requirements, where it depends on the ratio and how you're looking at it. But essentially the compliance ratios are 11.5% and 7.5%, just depending on the measure of like earnings and book value that you're looking at.
If they're really writing this paper at 30% ROE, why wouldn't more people come into this business? And then secondarily, if you look at unemployment rate within the 20 to 30-year-old cohort, it's relatively high versus history. And there's potential, may happen or may not happen, AI may cause incremental job losses in that cohort. How are you thinking about that?
Sure, yeah. So I would say that the industry as a whole is incredibly highly regulated. Some of the largest players have actually exited in the last 2 years, Wells Fargo and Discover. Discover exited as they were pursuing this merger with Capital One, so there were regulatory concerns. And then Wells Fargo exited, in the second year of COVID, and I think they were shouldering more losses from COVID. Both those programs were about 50% of Sallie Mae's size. So Sallie Mae, in terms of like the whole market, they have mid-single digit share. These firms had like low single digits, basically. So the biggest competitors have exited. In terms of new ones that have entered, a lot of the biggest one is SoFi. SoFi has positioned themselves as being more of like a user-friendly lender, but functionally the pricing has been the same, and they don't run as many like differentiated lending programs as Sallie Mae. Again, it's incredibly regulated, and you need to have the capital. And in addition, Sallie Mae is competitively advantaged because they have 2,100 direct like sales relationships with these colleges, and that's something that they've prided themselves on. So there's really high barriers to entry to this business, both on an operational level and a financial level. So that's typically why you don't see new competitors. One area where people will try to compete on refinancing, but that's less of a concern here for Sallie Mae because, I mean, you're buying a loan originator that then they sell the loans off to buyers in the open market or with this forward flows agreement, KKR.
And what about the unemployment rate and also potential risk from AI?
Yeah, I think that's kind of one of those known unknowns where it's something that's a little tougher to quantify. I think there's two things maybe to kind of wrap our heads around. So one is just in terms of the number of federal borrowers. This is from educationdata.org, which just kind of looks at things generally. I think the AI question is somewhat about the value prop of college and higher education. Enrollment in that case has remained somewhat flat, even going back 10 years, call it. And
Actually,
then when it comes,
I was thinking more about credit losses, because if they don't have a job, it's kind of harder to pay back.
Yeah, so in 93% of these loans are co-signed. Functionally, the co-signer is someone of better credit quality, so it's typically the parent. There's no bankruptcy reform that's really been proposed, but basically in order to take a full credit loss, I mean, the signer of the loan plus the co-signer would both need to declare bankruptcy in order for the company to really lose money.
Just to go through known unknowns a little bit more, could you talk about the current balance sheet, why it was constrained, where the lending comes from, whether or not there's a duration mismatch or not? And if you go back to the P&L for a second,
Yeah.
There are considerable gains that go through the P&L, so the company obviously has an active market to buy these securities. And it gets back to that sort of same question about financing. If there were, similar to what happened during the great financial crisis, where liquidity dried up, right, and the buyers disappeared for these loans, and your provider of financing no longer is able to do that, how much excess capital would they have to be able to continue to make loans and support that customer? And if that were not to happen, would they be at a disadvantage to, let's say, a bank that's funded by deposits, or would that have policy implications by the government that might decide we're better off doing this ourselves because these guys don't have any sustainability through a difficult period? Or you just sort of take us through those risks as they exist inside this business based on how they're funded?
Yeah, sure. So I'll answer the second question and then revisit the first. So as you can see here, this is kind of just like a balance sheet snapshot. So in the second section, we have our education loans plus, the other taxable securities and the cash that they have on the balance sheet. The cash is in excess of the book value. So the book value today, I think, is about $2.5 billion. I'm sorry, did someone say something? Or is in excess of $2.5 billion, and cash is currently at $5 billion. In terms of the liabilities that they have on the balance sheet, it's a combination of these retail deposits, which the retail deposits are like high yield savings accounts and CDs. And these are borrower commitments that are locked up for, the specific duration escapes me, but they're locked up for a long time and on a multi-year basis. So I think there's limited risk of a bank run. In terms of just kind of this overall doomsday scenario, I mean, realistically, when you go back and you look at what happened in the GFC, the combined Sallie Mae entity, when they were with Navient, did come under government conservatorship, and it's like, not worth glossing over that fact. However, part of the spin with Navient was the separation of that full servicing arm and all of the pre-2014 loans from the rest of the entity. So on the Sallie Mae balance sheet, you have 2014 loans and later. So you don't have these like really long dated loans that go back, 20 or 30 years. And then on top of that, you have like book equity to protect you. But I think the company is like sufficiently well capitalized, at least in the regulator's eyes. And I mean, this, if there were like a major financial crisis, I think they would certainly run into trouble, but this also wouldn't be the only bank with problems.
Can you go to page 15?
Yeah.
So people talk about variant scenarios. I'm just curious versus Wall Street, which is not obviously valuing this as a capital light compounder, right, at 27 or wherever it was today. Yep. So the balances grow. Like, do you really want to underwrite high single digit loan growth in 27, 28, 29? Like, what gives you the confidence? Those are big numbers.
Yeah, so the high single digit loan growth comes from that top down analysis on the originations. I mean, basically, to just put it in real terms, Sallie Mae originates $7 billion in loans today, and the loan originations that we're talking about being 100% ceded to the private market are 25 to 26 billion. So the opportunity that's coming into Sallie Mae's turf is 4 times the size of like the existing volumes today.
That's HR1.
That's HR1, and that's where is it? That's this analysis back here.
Okay, so Grad Plus plus Parent Plus is coming more private.
Yeah, so in the case of Grad Plus, that program's been completely eliminated, and it's worth maybe going through like why these assumptions are conservative. But Grad Plus is being completely eliminated. Parent Plus, they're introducing caps. So more or less what I've assumed is that about 55 to 60%, depending on the program, of those volumes are, Sallie Mae won't even touch those because they're just going to get rolled into some of like, they also put in some new elevated caps to help offset the difference, but you won't touch 50% of those loan volumes to begin with. The key line on this opportunity is that we think Grad Plus is a great opportunity for Sallie Mae, so we're assuming that 2/3 would be like competitive loans for graduate programs, whether it's MBAs, dentists, lawyers who are kind of studying for a graduate degree. That's sort of in the Sallie Mae like desired borrower wheelhouse. On the Parent Plus side, we think that's a less desirable opportunity, and we can get into reasons why, but essentially these are parents borrowing for like their child's education. We're assuming a much more conservative number, so about like 25% of the Parent Plus volume will be eligible. So, I mean, that's what gives us confidence in like this overall view and being able to grow the loan volume so much. It's that there's a TAM that's 4 times the size of like what they currently do today. That's being unlocked by the private markets for the first time.
And they'll just run it through their machine with this good CEO.
Yeah, exactly. It's like they have 70% market share amongst the other private lenders. So
Back to the light blue bars. Do you have any idea where the street is?
yeah.
in
So
there?
it's not on that page, but it's on this one. In terms of EPS, so the company did Q4 earnings and sort of their initial guide. The 293 and the 308 are sort of the estimates. Within that guide, kind of the big assumption that the company has that there's a 16% increase in SG&A that's not related to the loan loss provision, but they're going to pour all of this money into digital marketing. So on a $700 million cost basis, they're going to increase their SG&A by like $150 million. I think that's been one area of dialogue where I'm taking the under on that because they've been able to account for 60% of that going into like additional digital marketing and like sales marketing channels. The other 40% we think is basically like a placeholder number if this program starts going really well, and they'll spend more into that. But I think it's going to be really hard for them to spend all of that SG&A their first year, and that's sort of why you get the earnings variance there in 26 and 27 before you start getting the growth in the out years. Yes.
Two quick questions. What's the ultimate loss if it's a 4% default and the individual borrower or parent goes Chapter 11? What's the ultimate loss on that loan? And number two, when the gain on sale, there's maybe not explicit guarantee or warranty, but there's certainly an implicit guarantee and warranty. What kind of black swan event would need to happen for that to blow up and take Sallie Mae out?
Yeah, so I think in terms of let's take this in two parts. So on the default risk, the way these loans work is that people can declare for bankruptcy, but then you don't just get to discharge them immediately. It goes into this whole workout process. I am not familiar with the precise numbers on how much of the loan, like what the average losses are on the delinquencies, but the delinquencies are really low, and the charge-offs, the NCO rate is basically half of the delinquency rate. So the NCO rate is, I think it's like 2.5%, call it. So it's about half the delinquencies. That's on the NCOs. In terms of the black swan event, I think like what would really stress Sallie Mae is this bullish AI case scenario where a lot of new entrants into the job market have been really challenged as of late. And the cost of education, frankly, is not cheap, and that's why a lot of people are borrowing in the first place. And I think if young graduating students have a hard time finding placement in the job market, and their parents have trouble shouldering the bills for the education that they paid for, that has a much lower return now because AI is simulating a lot of basic work. I think that's sort of like the black swan worst case scenario.
I know we're over time. Just one more
Sure.
question that I couldn't figure out in my head. How are FICO scores going up at the same time delinquencies are going up?
Yeah, that's a great question. So there's no one clean answer, but there's some hypotheses that are going around. So one hypothesis on FICOs at least going up is that FICOs were going up for everyone because the government wasn't collecting on their portion of the debt, which it doesn't sit senior, but they weren't collecting on it. That's the working hypothesis on FICO. The other kind of force that's going behind that too is that the company has implemented tighter lending standards as a result of this CECL implementation. They had to commit $1 billion of capital off their own balance sheet to fund that. So then the flip side is that going forward, after committing all of this capital up front, they then went ahead and basically tightened their lending standards going forward. So in their investor day materials, I didn't put it in this deck, but they actually think like the quality of the loan book is growing stronger, and as they get into some of the out years, like only 2% of their loans like won't meet their current underwriting standards. So that's the story on FICO. What was the second part of your question? I'm sorry.
Well, FICO is going up at the
As-
same time delinquencies.
Yeah. And then on delinquencies, it's kind of related to this restart, but people may think of Sallie Mae as like a quasi-government entity. That being said, Sallie Mae like explicitly never paused repayments, but people think it's like transitory noise.
But it's normal for people to have a government loan to also have a private loan on top of that, right? So if you weren't paying your government loan and now you have to pay your government loan, there should be some correlation at least with the delinquencies in your private loan.
Yeah, just about everyone who has a Sallie Mae loan will have a government loan. Yeah, that's correct.
Delinquencies going up. So.
Yep. Yeah. And I mean, we've basically, like, our view in the base model is that they're flat at current levels. They're not necessarily going up, but the downside case assumes that they go up to 5%, which Again, that's like midpoint of where we are now versus GFC. Correct. Correct. Yep. Correct. Cool. Awesome. Thank you so much.